Let's welcome in Mike Wilson. He's the Chief U.S. Equity Strategist and Chief Investment Officer at Morgan Stanley. Welcome back. It's good to see you again. I'm glad you're back.
Thanks, Scott. Thanks for having me.
I want to go through some of the history here. Your note from September 20th was the day before you were last on with us. Much talked about. We focused on it here. Quote, will it be fire or ice, you ask? We don't know, but the ice scenario would be much worse for markets, and we're leaning in that direction. Ice would be a 20% correction, a, quote, more destructive outcome. Obviously, that never materialized. October 18th, with the S&P up 3% since then, you were still calling for a big decline in stocks, Mike, but you started to acknowledge, I feel, that your call was looking a little bit shaky. Quote, alive and kicking. Retail proves resilient and buys the dip once again, forcing many institutional investors who share our fundamental views to cover and chase. What I feel like a bigger pivot came but a week later, October 25th. You seemed to throw in the towel on any near-term correction. Quote, equity markets may remain well bid in the near term. Seasonal strength and strong equity inflows from retail and other passive investors are keeping the equity markets aloft. And then finally, on November 8th, it appears to us that you all but admit, Mike, that your call was wrong. Quote, we've been surprised once again at the magnitude and speed of the move higher. As we approach our bull case target of 4,800, we ask what is driving it and how long it will continue. I note that since September 21st, the S&P is up 7%. And as I said at the outset, we sit only 3% from highs. It feels like you've been chasing your own predictions, Mike.
Well, that was a great book report, so I'm glad you're reading our research. Look, I think that it's pretty clear. The fire and ice narrative that we laid out back in September is what's happening. The ice portion has not happened, but the fire is happening. That was the crux of our call in September, and the crux of our year-ahead outlook on November 15th was that inflation, which was running hot, and the Fed was going to have to respond to that, and that's exactly what's happening. So look, the key call for us is that valuations are just coming down. And we made that call back in March and April of this year. We call it the mid-cycle transition. There's going to be a rolling correction. And that's kind of what's happened. And we've navigated it really well under the surface. And the S&P has been very resilient. And that's what those comments were in October and November, was that we had strong seasonal strength. We had incredible retail flows. We suggested that we could rally into Thanksgiving, maybe a little beyond that. But that, as you approach 4,800, the risk reward was really poor. And I think that's sort of what's going on now. We're seeing, the real leadership names, the large cap names are now starting to kind of fall by the wayside, which is exactly what happened in 2018. The last time we had sort of that rolling correction idea, we called it the same thing back then. And it always ends the same way, Scott. It ends with, the bastions of safety finally taking a hit. So look, what are investors supposed to do right now? Well, first of all, they shouldn't be, risked up. Okay, the risk reward has not been particularly great since September. And that's the damage that's under the surface that Josh was, correctly citing. Small cap stocks, lower quality parts of the market, all the areas that we've been underweight have been underperforming. And the things that have been working is large cap quality. Now, what's changing today, I think, and this is something we've been talking about for the last couple of months, is that we're moving away from large cap quality growth to large cap quality defensive. Okay, and that's a big shift. And that's what we're seeing in the last week and a half or so. So what is the market? What is the market thinking now? Well, now we're talking about the ICE scenario. And that's something else we wrote about back in October. We said the ICE scenario has been put off, but it hasn't been eliminated. And that's going to be the slowdown that Josh was also referring to in the first and second quarter of next year, which is that we're going to get gobs of inventory now. Now we're going to get the supply is going to catch up. And I actually agree with Josh's comment. We're probably seeing a peak rate of change in the inflation measures. They're still going to be high, right? It's still going to be intolerable for the Fed, meaning 4% inflation is not a level they're comfortable with. So, but they're going to come down because supply is going to pick up. And the question I think we have to ask ourselves as investors now is that going to create an earnings problem for a lot of companies that people are not expecting earnings problems from? Because look what's happened. Companies have expedited supply. They've hired a bunch of labor at higher prices. And if there's excess supply now in the first or second quarter, potentially temporarily, that could lead to margin compression. So we'll see how that plays out. We're not sure about the ICE scenario yet, how icy it's going to get. But the fire part of our narrative is definitely in gear, and we're highly convicted in the multiples coming down, which is why we reiterated that in our year-ahead outlook on November 15th.